Within the last lesson, we learned about credit as well as how to acquire it. Today we're going to go one step further and begin our discussion on credit reports and bankruptcy. A credit history is an essential item in today's world. Throughout this presentation, you'll receive instruction on credit reports and scores, as well as how to increase your FICO score. In addition, you will discover how to make corrections to your credit report and the effects of bankruptcy. So what is a credit report? A credit report is a summary of all your money history, from savings accounts to loans to credit card payments. If you're like most teens, your credit report is pretty empty. Maybe you have a savings account, but you probably have no history of anyone ever lending you money or giving you a credit card. Even so, it is probably a good idea for you to order your credit report once a year. The first place to go for your free credit report is the website www.annualcreditreport.com. Here, you can apply online for your report from each of the 3 main credit report companies. This lets you know what credit companies see when they decide whether to loan money to you. A FICO score, or credit score, is a number generally from 300 to 850 that tells creditors how good a risk you are to them. If your score is above 700, you are a low-risk lender and demonstrate good financial health. If you are below 600, you are high risk to lenders. You could get higher interest rates or get turned down for a loan or credit application. A good credit score can help you in many ways. It can lower your interest rates. For example, someone with a score of 725 applies for an auto loan and gets an interest rate of 5.518%, while the other person with a score of 550 gets a rate of 16.939%. That can amount to paying more than an extra $500 over the life of the loan. Other incentives for a good credit score include speeding up credit approvals, reducing deposits required on utilities, getting approved for apartments, and obtaining better credit cards, as well as car loans and mortgage offers. So what makes a good credit score? Credit scores are based off of these estimates and calculations. 35% is due to your credit history. This includes late payments, bankruptcies, and other negative items that can hurt your credit score, but a solid record of on-time payments helps your score. 30% is how much you owe. Credit scores look at the amounts you owe on your accounts, the number of accounts with balances, and how much of your available credit you are using. The closer you are to your credit limit, the lower your score will be. 15% is due to the length of credit history. A longer history of using credit responsibly will increase your score. However, you can get a high score with a short credit history if you've made all your payments on time or paid off your credit cards quickly. 10% is based off of new credit. If you recently applied for or opened new credit accounts, your credit score will weigh this fact against the rest of your credit history. Finally, 10% deals with other factors. Several minor factors also can influence your score. For example, having a mix of credit types on your credit report, credit cards and installment loans such as a home or car loan, are normal for people with longer credit histories and can add slightly to your scores. Here are some ways to boost your credit score. Pay your bills on time. Late payments or defaults can really hurt your score. Keep balances low on your credit cards. High debt levels can hurt your score too. Apply for and open new credit accounts only when you need them. The most important way to improve your score in this area is to pay down your revolving credit like credit cards. Check your credit report regularly for accuracy and contact the creditor and credit report agency to correct any errors. Finally, if you've missed payments, get current and stay current. The longer you pay your bills on time, the better your score will be. Take a look at the table provided and take note of the specific actions you can do to raise your credit score. On the left side of the table states the action, and on the right-hand side of the table shows how much your score will boost with this act. So who requires a credit report examination? Many times insurance agencies, potential creditors, financial institutions, landlords for renters, and even potential employers will look at your credit report. If you feel there is an error within your credit report, what should you do? First, you should write a letter to the credit bureau that has the incorrect information and/or information provider. The credit bureau has 30 days to investigate. If the investigation is not completed by the credit bureau within this time, the information must be dropped from the credit file. For those individuals whose debt becomes too much to handle and opts to file bankruptcy, many actions will take place. First, filing bankruptcy clears all debt with the exception of your student loans. It rids yourself of all assets and will remain on your credit report for 10 years. In addition, it ruins your credit score, making it hard to receive future credit lines. We have now completed the video. Once you've completed the entire lesson in video, you should be able to understand that your personal credit history and credit score determine whether or not you qualify for loans and the interest rate on those loans. In addition, you should be able to understand the importance of maintaining a high credit score.